Today we are talking about why digital bank, how digital bank differentiate themselves with the normal banks, or how I can describe you that digital bank is different than the normal legacy bank. I'm Datu Muhammad Arif. I worked with the bank 28 years and having a huge experience setting up in a Standard Chartered Bank the digital banking, and as well as in a Faisal Bank to create a digital banking. And I was watching this whole two digital bank has been created by the Standard Chartered Bank. One is a Mox in Hong Kong, and second is Trust Bank in Singapore. So this is something that we are looking forward in a 3 to 4 years, that how the banks, digital banks, are performing. Second is how to set the strategy and why bank has to come up with some of the products. To start with, let me show you the two quotes. One from the Bill Gates, and he says that we always overestimate the change that will occur in the next 2 years and underestimate the change that will occur in the next 10. This Bill Gates had said quite long, almost 8 to 10 years back, but very relevant in a way that how we overestimate and how we underestimate. The second quote which I want to share with you is from the Nadella. He's a CEO of Microsoft, and the two quotes I can share from him. The first is, over the next 10 years, we will reach a point where nearly everything has been digitized. The second quote is, we say 2 years of the digital transformation in 2 months. So these two quotes tell us that how the digital transformation is happening in the world. In the banking sector, it is happening in existing banks, means that legacy banks. But the large challenge to the digital bank, because they have to start from the scratch. So when the digital bank starts the bank, they have to see very differently. It is not like the normal legacy bank. I would like to share with you what are the 6 things which digital bank or virtual bank should do differently than normal bank, and why. So what are these 6 things which differentiate as a digital bank or the virtual bank for the normal legacy banks? So I created a module of 6 areas. It can be more, but I will try to cover all this into the 6 areas. The first is a customer segment. It's very important that normal bank is doing business differently. Like a lot of banks where either they are purely consumer banking bank, or more focused towards the wholesale banking or the corporate banking and the less of consumer banking, or they are more into the treasury and the SME and treasury. And trade as well. So if you see the Standard Chartered Bank was all a corporate bank or wholesale bank, and their strength was trade. And what happened always, that whenever we go for a consumer banking, it is a product to the country and our customers, not profit making segment. The always profit making segment was a trade and wholesale banking, and of course treasury, because we were the top 5 fund transfer in the dollars. So if you compare with the digital bank, every digital bank starts with the consumer banking, where the mass is there, where the volume is there, where their segment is. So very important that they have to select the segment. So customer segment is a one area where they have to differentiate themselves. They have to understand which segment they want to go for, whether they want to go for there is a bank in US which is purely focusing on a university students to give the loans. It's a very different segment. If I take the example of N26 or Revolut, it is very different. It is more focused towards the consumer banking. The same as if we take the Hong Kong, which is Mox, it is very much like consumer banking, but now moving towards the wholesale banking as well. So they have to look into what is their segment. I'll come later on. I'm just putting up an introduction of these 6 items first. The second is the channel. So channel is very different than the banking sector. Digital bank or the virtual bank is not having a branch banking at all. So there is no branch. If there is no branch, there is no visibility of the bank as such in the market and with the people. So when you are asking that what channels they have to use it and how they can be able to create a customer experience without having a branch banking, that's what exactly the digital banking or the virtual banking. So when you see the channels they come up in a digital bank, is first is usually they come on a mobile banking. So very strong mobile banking app has to be kind of super app, which has to be able to do the almost everything. And in certain countries, they are going for the internet banking as well. And there is other channels as well, like they have to see if they are not having a call center, how they have to give a service to the customer. Same as if they are not having an ATM, so how they can be able to use a white label ATMs, how they can use any ATM available in the country, which they can be able to link in and be able to give the services to them, to their customer, or how they can be able to do any voice or video kind of banking. So channel is very, very different than normal legacy banks. And legacy banks, usually you see the legacy banks are having the ATM in their own branches. Majority of, I'm not saying, but in a digital bank, it is not. It is, they are taking on either white label, like UK. There's a huge number of ATMs available which they can link, like Sterling Banks or Atom Bank or other digital bank. They are linked with the ATM network and providing the debit card or the ATM facility or the cash withdrawal facility to their customers, or even the cash deposit through the cash deposit machine. So it depends on the country as well. The second thing is very important on a channel is how much is the penetration of the first financial inclusion in the country, and second is digital financial inclusion. What is the difference? Financial inclusion is all about how many people are having an active account in the country. So when you are taking a kind of Hong Kong, Singapore, Malaysia, it is almost 92 to 95% people are having account. If you are going on active, probably 80%, 85% people are having an active account. But when you go to India, or when you go to Pakistan or Bangladesh or Vietnam, you can see the first digital financial inclusion is less. Means that like in Pakistan, I'm aware of that around 50% of the people are having only the account in the bank. When you go to the digital financial inclusion, it is somewhere around between 37% to 40%. India is almost the same, slightly the number 2-3% here and there, but India is having also the large population. So if we are talking about that India is having a more than a 50% financial inclusion, it's mean that 500 million people are having already the account. And second thing is that this smartphone mobile, what is the penetration level? Like if you see the Malaysia, Singapore, Hong Kong, almost everybody is having a mobile. In fact, it is more than 100% people are having the mobile, means that some people are having two mobiles as well. So in this market, it is a quite mature market that everybody is using mobile. And if you go to the China, over there is same. I have visited Shanghai and Beijing, and over there everybody are going on a WeChat through the mobile. So it is almost 100% over there. But when you go to Pakistan, Bangladesh, Sri Lanka, African countries, and some of the countries which are coming up, their smartphone penetration is low. So if you take an example of Pakistan, smartphone penetration is around 60-65% only. So when you are saying that 65% only, it's really they have to look into, when the digital bank really focusing on the channel, they have to see that what are the customers we are really looking for. Same as if the half of the population is not having an account, so how you are really looking forward, how you can be able to go for it. Now, third thing is, which is digital products. So product is common in every bank. Like when I started 28 years back in a banking, I heard about three things: current account, saving account, deposit account. Today also, it is again the current account, saving account, deposit account. You can call it a smart current account, you can say digital current account, you can say smart saving account, whatever the name you can give it to. But these are the very basic deposit accounts. And if you go for a lending loans, it is same. The loan is for the short term, long term. It is how you have to do the credit scoring and everything. So loan is also very similar. Loan is not different. Now the current banks are doing the credit scoring, and credit scoring is all about very similar, like about your credit card scoring. Same as for the bank credit current accounts or bank account credit scoring, which tells you that how many loans you have taken in the country or in the banking sector, whether you have an ability to return back or not, and on that basis they give the loan. Some are cashback loan, means you have the enough cash in terms of deposit or the fixed deposit, and you want to take some cash against it, or you have a credit card and you want to take the cash as a credit. But it's all depend on how is your scoring is working, and scoring is working very differently in a legacy bank than bank in digital bank. Digital bank see how is your behavior in the last 5 years, that you are returning, you are paying your bills, so all the social media, utility bills, and every data tells you, and AI basically takes out your score and stores along with you. So when you are applying for a loan, within a minute it can tell you, okay, here is your loan, or you cannot take a loan because of your credit rating is not correct. So products are different in digital bank. And the other difference, like I want to go, the first challenge to the every digital bank is how to open an account. So how to open accounts, the first thing comes into the KYC, know your customer, and that is regulatory. There's nothing to do with like a bank. Bank are bound to know customer before they should open an account. Now, there is a relaxation in some of the countries. Some of the countries allows to open account first and then you can do the KYC later on. However, knowing your customer is very, very important, but always. So when we are going to the branch in a normal bank and trying to open an account, it is much easier because you are producing all the documents over there and showing your identity, and they do the KYC then and there, and they can be able to open an account over there. Whereas in a digital, it is challenging on a two aspect. One is how to do the KYC to open an account digitally. So digital KYC is a big challenge, and there are multiple solutions are available in the market. However, when the digital bank is going into it, they have to understand this complexity. The second area is the identity management, all about creating identity, verifying the identity, and whenever there is a payment or anything, they have to verify the identity as well. Now, the second thing is a payment. Digital bank is very different than in a payment as compared to the normal bank. The normal bank is mainly having a large size of the payment. The other thing area is different from digital bank to the normal bank. Normal bank is also having a large number of transactions on a utility bills. And the digital bank is the same. The digital bank is the main benefit is they are providing it to the customer to manage their spending. And they have to design a fantastic services for a customer in terms of providing the more information what the legacy banks are doing it. So how it works basically that the digital the legacy bank is having a 3 tier. One tier is a top 20 customer. So these are the customers which can be corporates, can be very large deposit based customer. They are the prime customers. They are the private banking customer. They are priority banking customers. So this 20% is not really too much offering or too much asking for a very strong statistics or strong way of looking their account. And usually their size of their number of transactions are less, but the size of the transaction is large. When you come to the remaining 50%, which is core of the bank, which is the middle of the customers, they are doing every kind of transaction. They are doing a large transaction. They are doing a small transaction. In fact, quite a number of customers are looking to see their spending. They are looking forward to do the kind of some of the feedback from the bank when they are going over their budget, so they can do the budgeting within their mobile banking. And when their spending is going above than that, they have to inform that your spending in this particular area has gone beyond. And they give a lot of good information and presentable information in form of graphs to give kind of this spending mechanism. So these people are very much interested, these core customers, to see and monitor their transactions, legacy bank. And the last 30%, which is in a legacy bank, they call it tail management. So it is a very odd kind of name, tail management or tail customer. So the tail customers are all about that they are having some very small amount with the bank as a deposit. Hardly they are coming to do the transaction. Might be their payroll is not with the same bank. So their deposits are not coming continuously. And the bank is not very much then keen to have these people. So as per the regulatory requirement, they cannot tell anybody that we are closing your account. However, they can be able to tell under the regulation that you have to maintain X deposit amount with the bank. So bank wants that how per customer they are making money. So the revenue is coming, like when we are talking about this tail, banks are not making money on these tail accounts. So that is very, very much there. And how digital banks supposed to do that, they are into the tail actually. So this 30% maybe in a legacy bank can be 60% in a digital bank. And why I'm saying this, because it's not necessary that the people's payroll is coming to the digital bank. Might be it is coming to some their legacy bank, and then they want to keep certain amount into the digital bank to pay their bills, to buy some sort of things from various e-commerce sites, online ordering, food delivery, Uber payments, and a lot of these kind of payment if they want to do from a bank account, not from a credit card, they can be able to do so. But really, if you are asking me that in a digital bank, so in a digital bank, this 20% which I talked about, the periodic customer and private banker and a large customers, it's very low. So I'm not sure what is the percentage, but it can be less than 5%. Where is the even the core from a 50% to come down to the 30 to 40% in a digital bank, and the tail is heavy. So the tail is okay for with the heavy in a digital bank because their all processes are automated. So they not manual processing is happening at branch. So people are not coming and asking to the branch and saying that I want a checkbook, and this guy is a till guy. So or I want to have a credit card or debit card, or I want to have other facility. So when the bank is not having their deposit, how they can be able to give the better service to them. Whereas the digital bank, this core is slightly lower as well, but the tail is high. Tail is high means that the deposit size of each customer is low. So that's how the loyalty comes into. Like digital bank as compared to the legacy bank to the digital bank, my view is the loyalty is less in a digital bank as compared to legacy bank for the two reasons. One is the like a Standard Chartered Bank, where my experience is people are very proud when coming to the branch saying that my grandfather was having an account with the Standard Chartered Bank, my father was having an account with the Standard Chartered Bank, and now I am having an account with my Standard Chartered Bank. I told my son that he has to open an account with the Standard Chartered Bank. Now that's not norm anymore, by the way, because that loyalty is slowly going away, and people are more into the service base and the functionality base that what they are getting from the bank. So it is not all about loyalty, but it is all depend on that how their experience is, and if their experience is good, they can keep account with the bank. But the other reason the digital bank is having a challenge is that most of the people are young. So the digital bank customers' age is low. Like if you see the average age of the digital bank, you can find out 25, some are 30, 32, 35. But it is a young people. And young people are very much into value of my account, value of my bank, services of my bank. So if they are unable to get the better service and they have a better option, probably they can move very fast. The other benefit probably the digital bank is having, that they are very much willing to work with other payment system. Like they are willing to work with the Apple Pay, they are willing to work with the Samsung Pay, they are willing to work with the kind of PayPal. There's any other, like in India, there's a Paytm. Uh, or WeChat and others. So digital bank is very much willing to work with these channels. To digital bank, it is not a problem because they are experimenting as well. Legacy bank is very weak on experimenting. That's why quite number of digital transformation projects fails in a legacy bank because they are not used to do the experiment. Whereas the digital bank comes with this mindset of experimenting, coming the mindset of putting the products which can be able to give a different customer experience to the customer and different services to the customer. Now, in a technology, the lot of good core banking solutions are available. So, like, I don't want to name it, but I want to take it because of Temenos came up with a very different solution for core banking in for digital bank. Same as Oracle came up with the same thing. I liked one Bamboo, which is it is a Bamboo. This is the core banking, which is kind of GL type of system, where all the surrounds are APIs. So they build in a way that you have to be able to customize every API very fast. So your app is on a top and connecting with this core banking. And those core bankings are now available on cloud. So one of the things is very important for digital when they are taking a cloud banking solution, because I prefer it as long as regulators are allowing it, because then their cost is more towards per transaction rather than upfront you are putting a cost for the implementation or the solution cost. So you are not paying for any license, you are not paying for first time cost, you are paying on the basis of transaction. And for digital bank, it is much easier because they are starting from a zero level to next level. So every level, it is all about the transaction based cost. So if cloud, to me, core banking is the solution. There are so many other ways to basically do it. Like API, I can give you the example of Hasselbank when I was doing putting up a super app, like they want to have full digital banking through a mobile bank. And we developed in 1.5 years around 300 APIs. It is internal APIs, external APIs, like public APIs. So there is a number of APIs. So if you are having a corporate client, they are having another system, ERP, how you give the public API to them to connect their system with that. So it can be private, it can be public as well. So depend on your corporate. If corporate is looking for a very private API, you can give it to the private API. So API plays the vital role when you are going into the digital banking. And app is very important because the change in the digital banking system is more often than actually legacy bank, because you are building a bank. So digital banking is kind of a staircase strategy, means that you are going step by step. So if you are going to the 40th floor, at the end, you have to go to the first floor, second floor, third floor, fifth floor, sixth floor, seventh floor. So when you are putting up a solution, technology solution, it should be capable of What is your roadmap? Whether it's a roadmap of a 10 years or 15 years or 20 years, but there is a roadmap. And by the way, you don't know what will come in the 10 years. So I can understand, I showed you the two codes, either underestimate or we overestimate. So underestimate means that we have not think about how fast the technology can change in the next 3 years, where we are thinking about it will change in a 5 years time or 10 years time. So we are now in the age of Moore's law. So every year technology is doubling in the every area, whether it's a infrastructure on a processing speed, or it is a software, or it is a artificial intelligence, or it is a RPA. Every area you can see the speed of technology is very, very fast. So when you are choosing technology, you should be very careful. The other area is you have to be very careful when you are putting up a technology solution is your cybersecurity is very key, because the legacy bank is having a branch banking where some of the areas transactions are happening at a branch, whereas in digital banking, it is totally exposed on internet, totally exposed into the cloud. So the cybersecurity is a big piece you have to see when technology you are bringing in. The second area is you should think about information security as well, your customer data protection. Many countries or most of the countries are having the Data Protection Act, and digital banking has to understand the Data Protection Act and understand what are the liability they have to ensure the data protection. And of course, the other areas are very important because of their crisis management. And normal, the banking is doing the crisis management for 150 years. Bankers are used to work on the crisis management area. So when the COVID came in, and in one of the interview, I said that bankers are the banking area. I think they are very much resilience on how they can address the crisis. And what I said at that time, to us, it is a opportunity, because we are thinking more converting at those days Faisal Bank to the digital bank. And my view is that our digital transaction has to go to the multifold, which is exactly happened. And we have gone to the 20 times more transaction during the COVID. And we cannot ever achieve this if there was no COVID. So I always said during the COVID, we achieved more digital penetration than ever. But on other side is all about the crisis management, BCP, simulation of the BCP. So all these issues are related to technology as well. Like what technology you are taking, your BCP should be built into it. And let me tell you, it is very different than the legacy bank. And I have to have a separate video on BCP for digital bank, because you don't have people. You don't have thousands of people sitting somewhere to run your operation. So if in a Standard Chartered, I have 16,000 people in India processing operation transaction, and 5,000 in Malaysia. I have a backup. I have an understanding that how we have to adjust it, how we have to, and critical transaction. So what is the critical business we have to continue? And you have only the digital bank. You are running a payment. You are running a large scale of the only volume of the payment. So can you be able to move from auto to manual? Answer is no. So what it should be your crisis management? What should be your BCP? Your BCP cannot be moved to the manual. Shut down these 60% of the transaction. only work for the 40% of the transaction. These are the identified 40% of the transaction. And let me tell you, it is nightmare when you do the BCP without telling people. Digital bank, it is twice difficult. They have to understand. Although might they are having most of the system in cloud, transaction might not be it cannot be that way, but they don't have the buildings to process those as well. So their BCP is different. Their BCP should be different. Their crisis management should be different. Of course, there are people who has to take the decision. It's not that digital bank are running without the people. There are hundreds of the people into the digital bank as well, which they are taking the decision somewhere. So if the building is not accessible, how the BCP has to work. So I've taken so much of a time on a technology. Technology is an easy piece, let me tell you, because so much of a solution is available. You have to select in between. Looking into your roadmap, looking into your product, what you want to design, looking into the 100% automation on a processes. 100% should be a straight through process. So technology piece, you can be able to get decision faster. I can keep going into the technology of ATM, technology of clearinghouse, technology of the various tools, but I will do separately one video on a technology. Now, jumping on to the regulations. So regulators are looking forward digital bank as same like legacy bank. Why I am saying this? Because the regulators see the interest or protect the interest of the customers and customers' money, whether it is in digital bank or whether it is a conventional bank, regardless of. As long as their deposit is concerned, regulators are going in a very heavily to protect the customers. And on lending, they want to be protecting the industry and the banks. So the regulators cannot be treating differently customer interest in a digital bank than actually the conventional bank. So regulators always comes into the same framework, maybe 10%, 20% less, but it's supposed to be the very similar framework for regulation. So the challenge is a regulation. To comply with the regulation is the most expensive thing now in a banking. So you heard about that HSBC got a $7 billion penalty from US, like this New York payment, which is, we call it, I think, Zone 12. And same as Standard Chartered got some $5 billion penalty from our regulators. So, and even in a local country regulations, Standard Chartered is more than in 72 countries. Every country has a different regulation. So we have to comply with every regulation. Now, when you are going to the digital bank, you have to comply with the regulation. There is no other way. So cost of doing regulation is very high. I'm telling you, especially on fraud detection, especially on when cross-country payments, which is sanctions monitoring, people monitoring, which are high risk people identified within the country or across the blacklisted people. So it's not only a one area. There are 20 areas where you have to build the mechanism to protect you from a penalty means that you have to comply 100% regulation. So when you do 100% regulation, you have to do so much of automation. Now, the digital bank whole model is a low cost. So when they are going into the regulation, there's a big challenge how they can be able to put the money into the automation. Is a chicken and egg, because they have to first conceive the product, develop the product, going into the automation of a process is so on one side they are building the bank, on other side they have to build the regulation. Usually we call it regtech. So when we are saying fintech, we are saying regtech. So a lot of solutions now available on a regtech, but regtech is very specific to the countries because each country regulations are different. I can give you the one example here. I can give you so many, but I can take a one. Malaysia, we have a secrets report. Every bank has to produce every day and send it to bank regulators, Bank Negara, by I think by 4 o'clock. So all the transaction happens on that day has to be part of it, even though it is a limit enhancement, new limit setting, withdrawal, it is deposit, everything there. And they have a huge mechanism or query system around where they exactly check on a day-to-day basis where the bank is. And if the bank makes a mistake, either it is a mistake from a system, it is a mistake of some human being, or whatever, so they put the penalty on a per transaction basis, per information which was wrong. So if think about it, that will happen into the digital bank, can they be able to afford paying also the penalties? And by the way, it is not small, because if a system did the wrong thing, these transactions are not 1, 2, or 3. These transactions can be 200 transactions. In one specific area, the system has having a bug. And in that case, or you have implemented something new and this has gone wrong. And what is the penalty per transaction base? So the people are paying 5 million, 6 million, 10 million as a penalty. So the bank should be ready to pay the penalty if they are not doing the things right. And digital bank have a challenge because you are building, as I've given the example, stair by stairs. So whenever you are building whenever you are introducing a new product, whenever you are putting up a new functionality, you have to make sure that existing product functionality and automation should not affect. So bank are having a separate team for UATs. They did a huge UATs when they are doing and implementing the new things. And we have to understand in digital banking how they can be able to cope up with these kind of resources, which are some or most of the large banks are having their own team, which are testing, configuration management, kind of stress testing, operational testing, everything. So this is regulatory. Now coming into the last topic, which is risk management. So as I said, the regulations is on one side, products, process, services on another side. When you are coming to the risk management, you have to have a series of the areas to manage their risk. So you are, and it's very much similar like legacy bank. So it's very similar. But these banks are having years and years to spend on to develop the manuals for the risk management, develop the framework for the risk management on a very specific area. So there are 30 areas of the risk management, and each of the area they are having a separate main manual for the risk management and mitigating the risk in fact together. So it's not only the risk, but if how the risk has to be captured, how the risk has to be mitigated, and how we have to fix it on a permanent basis. Now, what is the difference between now for a digital bank and a legacy bank? Because this is what our topic is. Now, digital bank is different in a way that they are having a 500 pages blank in a file. Whereas in a bank, in a passage of 50 years or 30 years or 150 years in case of Standard Chartered Bank, they have a very strong, robust mechanism of a risk management. And they review every year, they review with the every product launch, they review into the every new regulations. So new regulations are coming regularly. As digital bank is new, there are a lot of new functionalities coming on a regular basis. A lot of processes are coming on a regular basis. A lot of automation is happening. So these blank papers has to be filled in, and it's a different. Why? Because it is not on a, it's blank. It has to be filled in. Whereas in legacy bank, it is there. Only you have to add annexures. You have to add or modify some of the areas. So huge challenge, even though if a digital bank hired a guy, head, which is chief risk officer from a bank, from a day one, he is in some situation. Why? Because his all training in a 15 years or 10 years was on the basis whatever the bank was having, how we have to modify it, how we have to change it, how we have to learn the lesson from the issues, mitigate it, and again change it. So it is a kind of circle. So he used to be trained on that basis. Now given to him a blank 500 pages in a file saying that here is the risk management you have to develop for each area. It's very different, very challenging, I'm telling you. So that's the issue. And I don't have the easy fix. I don't tell anybody what is the easy fix. The easy fix, can we take a person from a digital bank who's expert of risk management or operation risk or a business risk or enterprise risk? No, digital bank don't have those things. So the legacy banks are having it, but we have to take the people who have a different mindset for a digital banking. So if you are taking a person which is a hardcore chief risk officer, he is tuned to run a legacy bank where he has already everything. Same as it comes to the when credit scoring is happening. So chief credit officer of a function are used to with a different credit scoring mechanism, whereas the digital bank is coming up with a very different credit scoring mechanism. So this is a challenge. I don't think so. I have I can be able to give some easy fix on it, but I'm very much uh, uh, looking into that. People who are doing first time, they should get the help, uh, maybe from a consultant, maybe from some of the people who did it before. Like I said, that a lot of banks in UK did it this much earlier, in Germany as well. Like Sterling Bank is having now probably the full risk management manuals. And who did it, I don't know. Maybe they have done internally. Usually they do internally, and some of the piece they need a consultant. So I leave it here because the video is already long. So what I'm looking forward is, in all these 6 areas, I want to come up with the 6 videos in future. So please do subscribe and click the bell so that my all videos should come to you, uh, and you should be able to see it. Please do comment if you are seeing this video, because this channel is not that uh, large customers. So it's around 6,000, 7,000 customers, subscribers at this point of time. But I'm looking forward that with this a new way of putting in, there's a series I'm putting up, which is called Digital Bank. So thank you very much for the time being. Please wait for my other videos.